In this video we are going to talk about the dividend snowball effect. So before starting, please like this video and subscribe to this channel for future updates. Interest generated on money that was previously earned as interest is known as compound interest. This cycle causes interest rates to rise and account balances to rise at a faster rate, a phenomenon known as exponential growth. Because a small snowball quickly becomes a large one as it picks up snow while rolling down a hill, the concept is known as the snowball effect. The snowball, on the other hand, does not simply grow in size at a constant pace as it rolls downhill, it actively accelerates its mass gain. This is because, as it gets bigger, it gains additional snow with each revolution, since the snow it gained on the previous revolution is now hitting the ground and picking up snow on top of the initial snow on the ball. This, we believe, may be applied to high-quality dividend growth equities like the dividend aristocrats and dividend kings, which have increased their dividends for 25 or 50 years, respectively. By investing in exceptional firms, you may harness the power of the snowball effect to grow your wealth and income many times over. While these wealth generators can be found in a variety of places, a good place to start is among the stocks mentioned in this article. A practical illustration. Compound interest is, without a doubt, the most potent wealth creation generator on the planet. Albert Einstein is said to have referred to it as the eighth wonder of the world. As an example, consider a $100 loan with a 5% annual compounded interest rate. You would earn 5% on your $100 investment in the first year, leaving you with $105 at the start of the second year. However, in year 2, we are now receiving 5% on $105, resulting in a total interest income of $5.25 for the year. In year 3, we'd receive 5% on $110.25, for a total of $5.5125 in interest, and so on. Your $100 will have increased to $265.33 over the course of 20 years. Your investment would have only risen to $200 if it hadn't compounded, and instead had been paid a consistent $5 every year. As you can see, compounding may quickly lead to extraordinary results, with compounding increasing profits by 65.3% over a 20-year period in this case. The snowball effect in action. How can you utilize the snowball effect to your investments to make compounding work for you now that you've seen how effective it is at increasing returns? We only need to look at Warren Buffett and his partner Charlie Munger, two of the greatest investors in history. All there is to investing is picking excellent stocks at good times and staying with them as long as they remain good companies, Warren Buffett says. This seemingly obvious statement actually contains 3 profound investing principles: 1. Choosing long-term compounders, 2. Locking in good compounding rates, and 3. Having the patience to let the snowball effect work for you. It's easier said than done to spot long-term compounders, but they all have the same characteristics: high returns on equity and strong and lasting competitive advantages that allow them to maintain their high returns on equity for lengthy periods of time. Why are these 2 characteristics so crucial? In the following quotes from Charlene Munger, she says, "Because it is the single most essential determinant in deciding what return you will earn on your investment over the long run, return on equity is extremely important. Over time, it's difficult for a stock to outperform the business that underpins it. You won't get much more than a 6% return if the business earns 6% on capital over 40 years and you hold it for that long, even if you bought it at a tremendous discount. Conversely, if a corporation earns 8% on capital over the course of 20 or 30 years, even if you pay a high price, you'll end up with a fantastic result. You'll miss out on the full benefits of compounding if you have to trade in and out of equities on a frequent basis because they've lost their competitive advantages, and thus their capacity to compound equity at attractive rates. If you buy something that accumulates at 15% per year for 30 years, and then pays a single 35% tax at the end, the net result is that you keep 13.3% each year after taxes. If you bought the same investment, but had to pay 35% of the 15% you earned in taxes every year, your return would be 15% minus 35% of 15%, or only 9.75% compounded per year. So there's a 3.5% gap there. And the impact of 3.5% on numbers over lengthy periods of time, such as 30 years, is absolutely astounding. Examples of the snowball effect. Dividend growth stocks are those that have the long-term competitive advantages needed to compound equity at high rates of return over lengthy periods of time. These are stocks that have a track record of not just paying out additional cash flow to investors year after year, but also growing dividend payouts year after year. This results in a double compounding impact for investors, resulting in an exponentially expanding stream of dividend payments. In this situation, the investor's yield on cost, the amount of dividends received in relation to the initial dollar amount invested in each share, rises every year, resulting in some spectacular wealth-building effects over time, as we'll see in the following cases. Number 1. Coca-Cola. Coca-Cola, KO, is a perfect example of a long-term compounder with long-term competitive advantages that has resulted in exponential profits for long-term investors. It has over 500 unique non-alcoholic brands that it owns or licenses. Since its foundation in 1886, the company has expanded to more than 200 countries, with its brands accounting for around 2 billion servings of beverages each day and generating roughly $35 billion in annual revenue. It has established a strongly loyal following among consumers thanks to its powerful name brand and exquisite tasting drinks, allowing it to charge higher prices and multiply investor equity at double-digit rates over time. This is illustrated in the chart below, which may easily fit an upward trending exponential curve. Number 2. Lowe's companies. Lowe is another great example of this type of investment. It was formed in 1946 and is based in Mooresville, North Carolina. In the United States and Canada, Lowe's has approximately 2,000 home improvement and hardware stores. As the second largest home improvement store in the United States, it has benefited from the long-term competitive advantages of economies of scale and customer loyalty, allowing it to provide investors with double-digit annualized returns over the past several decades, with an exponential curve that is once again distinctly upward trending. Number 3. McDonald's. Next, we have McDonald's, MCD, the world's largest publicly traded restaurant firm. Since its founding in 1940, the firm has benefited from the long-term competitive advantages of its strong brand name, economies of scale, and highly profitable real estate-focused franchising model to continue to compound shareholder value for decades. This company also has a stunning exponential total return curve that is moving upward. And, true to tradition, it has an exponential dividend growth curve, with original shareholders' yield on cost increasing by an incredible 33,460%. In 2008, the dividend was not reduced. Instead, the corporation went from paying an annual dividend to a quarterly payout, which put this chart out of whack. Number 4. Johnson & Johnson. Johnson & Johnson, J&J, one of the world's leading healthcare and pharmaceutical firms, is a fourth example. It was formed in 1886 and now employs over 125,000 people worldwide. With annual sales exceeding $81 billion, it benefits from economies of scale, a wide range of product offerings, significant intellectual property rights, and significant research and development investments, all of which have allowed it to consistently compound wealth at high rates for investors over time. It, like the other companies mentioned, has an exponential total return curve that is heading upward. Number 5. Federal Realty Investment Trust. Federal Realty Investment Trust, FRT, a well-known retail real estate investment trust, is our final example. The trust, which was established in 1962, focuses on high-income, highly populated coastal locations in the United States, allowing it to charge higher per square foot than its competitors. It has exploited its well-located and high-quality real estate, as well as economies of scale, as long-term competitive advantages as one of the largest real estate investment trusts in the United States. It has been able to compound wealth at an astounding rate over several decades as a result of this. It has a remarkable dividend growth record, with a yield on cost that has increased by 183% over the course of its history. While this isn't as spectacular as the dividend history of the aforementioned instances in this post, it's worth noting that as a real estate investment trust, it's obligated by law to pay out at least 90% of its taxable profits in dividends. As a result, it doesn't have as much money to reinvest in expanding its business. As a result, its dividend growth rate is much lower than that of a non-REIT, despite its overall total returns being comparable. What do you think about our video? Let us know in the comment box below. Please like this video and subscribe to this channel for our future updates. Thank you.